Hi, it's Matt Samet from Fortress Financial again, and today I wanted to talk to you about something important. People buy guaranteed fixed income securities and think they're safe. You know what? A lot of the time they are, but people don't understand that there's different qualities of fixed income securities which you truly have to understand. They are rated by agencies that are out there. There's three main ones in Canada that are used: the S&P, Standards and Poor's, the Dominion Bond Rating Service, and Moody's. So between the three of them, they will rate everything from bonds to preferred shares, and that's what probably most of you will own. And what's important is understanding when you should have certain types of securities in the cycles we're in. When things are at the beginning of a cycle, you can own slightly lower quality securities, and in preferred shares, the range goes from P1 right down to P5. P1 is by far the best grade. P5 is basically garbage. You don't want to own it, and good chance they'll actually be in receivership bankrupt on you. So if you, during periods, like I say, early in the cycle as economies are growing, P1, P2, and even P3 are acceptable. P3, the lower the quality, the higher the return is going to be. It's the exact same with bonds. They are AAA, AA, A, triple B, etc., all the way down to a C, and there's actually a D where they're basically in default. So you don't even in good times want to own C's in our mind, but you can own B's or higher. Now, things change in today's world, and I want to talk to you about that. World economies are slowing. Debt has been issued at the highest level in history for corporations. And the problem with that is they haven't been very selective on who they're giving money to. So there's a lot of garbage debt that's been given out there that inevitably in negative cycles goes bankrupt. That means debt you hold where you think you're guaranteed interest, you can not only lose the interest, but you can lose the principal. So it's critical that you understand the quality. And if we're going in the down cycle like we believe we are, both economically and from the stock market's perspective, the first thing you lose is the ability to sell low quality investments at a decent price. The second thing will be loss of the income because they'll have to forfeit paying out income. And the third, for those who don't survive it, you lose your principal as well. Awful cycle, not fun. Junk bonds basically are low quality bonds. In the last cycle in 07, 08, they lost 50% of the value. That's on average. Remember, there's a whole mess of those bonds that went bankrupt and people got nothing back. So it's critical to really understand the underlying investments that you have. Now, a lot of people will have a bond fund. You should check into it. Ask your advisor. What is the grading of the bonds in there or preferred shares? Others will own high income type funds, and they're thinking, high income, that's exactly what I want. Yeah, you do, but you sure don't want to lose your income. Currently, the cycle, junk bonds were down about, I wrote the numbers down here, 25% at the beginning from the 14th, from mid 2014 to about the beginning of this year. Over the last couple months, they've rallied a little bit, up 7%. They're still down 16% from their peak. More importantly, nothing is a straight line down. Don't think that this is better, because in the last crash, we had a correction, a run-up, another correction, a run-up, then the major crash. That's how crashes tend to happen and keeps investors invested. So caution here. Look at your quality of preferred shares. Only own P1s and P2s. Look at bonds. Only own AAA or AA. Otherwise, get out. So be very safe at this part of the cycle because we're going to hit some tough times. We'll see you soon in our next video.